Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. I'm DJ Cheong and I'm an investment strategist at Standard Chartered. In this episode, we'll discuss some of our key views from our global market outlook. Joining me today for this conversation, I'm glad to welcome Steve Brice, Chief Investment Officer, and Marco Iachini, our cross-asset strategist. The theme of our recently released monthly global market outlook is relentless optimism. Can you explain what you mean by this?
Yeah, I suppose the key thing here is equity markets have rallied extremely strongly from the March lows of last year, so up around over 80%. And obviously there's good reasons for that optimism, right? So growth is doing well. Rebounding strongly. We're seeing strong progress, at least in developed markets, with regards to vaccine deployment and reopenings. UK, US leading the way, but Europe also picking up. And policy remains extremely supportive. So both monetary policy, which we're used to, but fiscal policy has been eased dramatically as well in recent months, and further stimulus is likely in the coming months. And also, obviously, we've got base effects. So last year, naturally, the lockdowns led to a very sharp, unprecedented sharp fall in economic activity, and we're seeing the reverse of that coming through now. And that's true for both economic growth and earnings growth. So overall, we're seeing a very strong rebound. So that's creating this optimism in financial markets, and I think that's largely validated. The potential fly in the ointment is obviously inflation. We're seeing inflation expectations rise as we go forward, and that would normally lead to central banks becoming a little bit more cautious about how much stimulus they provide. But we're seeing central banks around the world focusing on supporting economic activity, looking through this short-term spike in inflation, and that just supports the reflation theme. So on a 12-month view, we still believe that equities are going to do very well. Obviously there are concerns in other areas, so investment-grade bonds, for instance. But overall, the risk rally looks likely to continue.
Steve, the title just sounded a bit worrying to me, especially when everything you said seems so positive. Doesn't it mean we should be fearful?
I think we share your concerns. I mean, if you look at valuations, they're expensive wherever you look, right? So if you look at equities relative to history, their own history, they look expensive. And it's true in the bond market space as well, in investment-grade bonds in particular. What we look at is saying, okay, where is the relative value between asset classes? And I think that's where equities stands out. So equities are cheap relative to bonds, particularly government bonds and developed market corporate bonds. So from that perspective, if we're taking a probabilistic view saying, okay, we've got all these positive factors out there and we've got equities still relatively cheap, then they're likely to outperform on a 6 to 12 month basis. Of course, that doesn't preclude the possibility of a short-term pullback. We have done over 80% in 12, 14 months. So that is something that we could be concerned about, but we would see any pullback as a buy on dips opportunity rather than anything more sinister on a longer-term view.
Now, on the pickup in COVID-19 cases in the emerging world, how does this affect your views?
Yeah, so obviously at the global level, we're not too concerned about this because the vaccine efficacy is still there. So as vaccines get deployed in a more widespread manner, as I say, developed markets is the key area where we've seen progress there. But as that goes out to emerging market countries, that should mean that we won't see further waves going forward. But in the short term, obviously, it's going to have an economic impact on earnings, and that's made us a little bit more cautious on Asia ex-Japan equities. So from our perspective, we prefer US and UK equities. So from a US perspective, obviously vaccinations and reopening progress is very supportive, as is the policy support we see from both monetary and fiscal policies. So that's one of the reasons that we like US equities. For the UK, vaccinations, again, a key driver, but also relative valuations and more tilt to value style are the elements that support our view on the UK equity market.
So the team has also become more cautious on credit. Marco, can you explain why?
Sure, thanks, DJ. I think before I answer the question, it would be beneficial to clarify what we mean by credit here at Standard Chartered, because it may mean different things to different people. For us, when we look at the credit universe, it's comprised by four main segments of the bond market, really. And that's developed market investment grade bonds, high yield bonds, and as well as Asia dollar bonds and emerging market dollar government bonds. So when we look at the level one, what we call level one asset allocation, so top-down level, we have become a bit more cautious on this area. And as Steve was saying, is as inflation might pick up, or at least expectations might pick up, we're trying to make our asset allocation a bit more resilient by reducing our exposure to some of these areas of the corporate bond market that are a bit more sensitive to shocks in inflation or yields. And particularly here, developed market investment grade and high yield bonds look a bit more exposed in our view. Also, when we look at valuations, here, DM, high yield, and investment grade bonds are much more expensive relative to emerging market and Asia dollar bonds, and as well as compared to the relative history. And therefore, we do think that the potential upside becomes more attractive in the emerging markets and Asia dollar space.
On that, we have also seen some dollar weakness of late. Is it ready to resume the downtrend, and what are the implications for gold?
No, absolutely. The dollar, especially if we look at the dollar, it's been strong, or perhaps stronger than expected in some cases for the first part of the year so far. It is something that we expected, but we have remained and we continue to remain dollar bears on a mid to long term time frame. Some of the catalysts for us are obviously the level of real yields, and that is nominal bond yields minus inflation expectations. We do think here that as inflation expectations may continue to rise in the short term, either because of supply bottlenecks or consumer prices jumping because of the reopening of the economies, we do think that real yields could potentially trend lower. And historically, this has been a catalyst for to make the dollar a bit less appealing to investors. And so we think this could be finally a catalyst that might drive the dollar lower going forward. And when we look at on the other side of the coin, I guess, to our gold views, we have remained quite neutral, have had a neutral view on gold with a bit of a bullish bias. And as we see the dollar potentially turning lower and real yields, which we know that historically have had a strong correlation with gold, as we see these also turning lower, it might become a catalyst for our gold view or our gold bias to be to lean upward from here.
Steve, Marco, thank you for joining our podcast today. And that's all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, visit our website at se.com under Market Insights. If you found this insightful, please rate and review us wherever you get your podcast from. For clients of Standard Chartered, you can check out the SE Private Banking app or reach out to your relationship manager if you would like a copy of our publication. Thanks for joining us, and we will catch you next time on Standard Chartered Money Insights.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.